these are the topics that I intend to cover. 45.4 on not all the aspects of 45.4, on one of the interesting aspect of 45.4, and that was in fact the first of the list of mithai that Abitan and his team wanted. Then certain issues on 194 are certain issues arising out of the amendment 37(1) explanation. Then non-compliant conversion of company to LLP. Then interesting issues on interesting controversy. It's not a new one, but certainly getting momentum as of today is the loss on investment of a subsidiary, shares of subsidiary, whether it's an allowable item or not. Then we'll take up a decision of the Supreme Court in Wipro's case, decision of Supreme Court in Sumanjit Agarwal, and certain do's and don'ts of IBC. So these are the topics that we have worked on. And I think one of the topic, I guess 148, somehow those slides are missing here. But nevertheless, if there are any questions on that, I'll be happy to answer them. So let's move on with this, and let's start with the first item. Section 45.4, applicability on stock in trade appreciation. Now let's understand what is the issue under consideration. Now, as we all know, 45.4, something which has been a subject matter of legal concern for several years, and right starting from Malabar Fisheries, Bankilal Vaidya, etc., etc., etc. And those old case laws right now ending with the recent Supreme Court decision, which says that a mere revaluation of an asset would also be regarded as a transfer, something which is disturbing to everyone. But at the same time, now that we are concerned with the new law, I'd not get into those decisions. But the new law essentially says that 45.4. What is 45.4? It is a tax which is levied in the hands of the firm, but it is actually the capital gain of the partner. That when partner receives any money or a capital asset when he retires from the firm. Now, this also includes members of the AOP, but for the sake of simplicity, I'm just referring to as a partner and a firm. So when he retires from the firm and he gets money or capital asset, and the value of the capital asset that he gets and along with the money that he gets in excess of the balance lying to his credit in the capital account, that excess what he receives becomes capital gain. Now, although it is a gain arising in the hands of the partner, the law says that it should be taxed in the hands of the firm. That's how this particular section is structured. And this essentially applies where cash is received or capital asset is received. However, if suppose the partner receives not a capital asset but a stock in trade, then to that extent, this section is not applicable. Of course, there will be applicability of section 9B, with which we are presently not concerned. So this is by and large the structure of 45.4, where we are told that it will be the gains which will be taxed. And how are those gains going to be computed? A is equal to B plus C minus D. What is A? A is the cash amount, B is the value of capital asset, and D is the balance in the capital account. So B plus C minus D. B plus C minus D is equal to A. This is the formula given to us in the Act. Now, this particular income is chargeable under the head capital gains. Now, under the scheme of the Act, capital gains is either short-term or long-term. And the taxation of capital gains essentially depends upon whether it is short-term and long-term, and that is how you calculate your indexation, you calculate your rate of tax, and arrive at the amount of tax to be paid on capital gains. Now, consider this, 45.4 is where a partner retires from a firm. So as such, what is he getting? He's getting cash or the capital asset on the retirement of the on his retirement. Now, what is, I mean, if you look at the general law as we understand today, what is the capital asset being transferred? So there is no capital asset which is being transferred as such, but there is a transfer by the firm firm to the partners. And so far as partner is concerned, his rights in the firm gets extinguished. So you can say that so far as partner is concerned, his rights are getting extinguished, and therefore what he gets is the sale proceeds minus his cost of acquisition, and therefore his cost of acquisition is what? In simple terms, it is the balance lying in his capital account, and therefore that is the capital gain chargeable to tax. Now, how do you calculate long-term or short-term? I would have thought that if the partner is a partner in the firm for more than 3 years, it should be long-term. If he's a partner in the firm for less than 3 years, it should be short-term. That should have been the simple way of dealing with this issue. But that's not how they're looking at it. They have a particular method of deriving how much of that gain is short-term and how much of that gain is long-term. And that is how they have enacted Rule 8AA5 and Rule 8AB. So Rule 8AA5 actually provides the mechanism of determining how much of that 45(4) gain is long-term and how much is short-term. And this classification depends upon how this 45(4) gain is attributed under Rule 8AB. Now, what is the meaning of attribution? We'll recall that there is Section 48(3) in the Act, which says that, look, when a partner gets certain assets or money, then there is a tax which is being paid at that stage. Now, it is possible that whatever he's getting is by virtue of enhancement in value of some of the assets which are remaining with the firm. So if it is because of the enhancement in the revaluation of the remaining assets in the firm, then the firm should actually get it as a cost when those assets are ultimately sold by the firm. So it either adds to the cost or it is reduced from the selling price at the end when the firm sells it. So that is that 48(3) in a way to avoid double taxation. And in order to give effect to that 48(3), they have this Rule 8AB to say, how do I attribute that 45(4) gain to the various assets which are remaining in the hands of the firm? So therefore, there is whatever 45(4) gain has been calculated by this formula, A is equal to B plus C minus D. That gain has to be attributed over the remaining assets of the firm. And when they are attributed to the remaining assets of the firm, whether the gain, so how much of the gain is long-term and how much is short-term, your Rule 8AA5 says that to the extent you are attributing it to the remaining assets which are long-term, it will be long-term, and remaining assets which are short-term, it will be short-term. And those remaining assets are long-term or short-term, you have to see on the date on which the partner actually retires. So this is the mechanism which by now we all are conversant with, because 8AB and 8AA is now there on the statute book for I think more than 6-8 months. So having said that, there are some strange situations where this 45(4) gain cannot be attributed to anything, neither long-term nor short-term. And if it is neither long-term nor short-term, then what happens to that gain is a question which is under consideration in this particular case study. So let's understand this by way of an illustration. XYZ is a partnership firm comprising of 3 partners, X, Y, and Z. X retired from the firm with effect from November 30, 2022. He will be paid rupees 700 in cash upon retirement. I'm eliminating all complications when he's paid cash, when he may be paid stock in trade, he may be paid by way of capital asset. I'm eliminating that for the sake of simplicity and focusing our attention on the issue in hand. So he will be paid 700 in cash upon retirement. The assets and liabilities of the firm at their carrying values and at their respective fair values as determined by registered valuer are given in the table here. So let's run through this table. It's essentially the balance sheet as on the 30th day of November 22, the date of retirement. And the carrying amounts of liability side, on the liability side, you have capital and other liabilities. The carrying amount of capital is 100 rupees. Whereas other liabilities is 100 rupees. So the total carrying amount of liabilities is 400. On the asset side, you have certain capital assets by way of depreciable assets, urban land, rural agricultural land, goodwill, other current assets, cash and bank, stock in trade. Total comes to 400. The carrying amount is this way. Then we have on the side of that fair market value of all the assets on the date of retirement. So fair market value of depreciable assets 60, urban land so much, rural agricultural land so much, goodwill so much, etc., etc. And on the last final column on the right hand side, you have the amount of revaluations. So depreciable assets 60 minus 50, 10 rupees is the revaluation. Urban land, which was 30 rupees in the books, is now 300 rupees to 270 is a revaluation amount, and so on and so forth. So total revaluation amount is 1800. Original costs or carrying values are 400, and therefore your revalued balance sheet is 2200 on the credits on the asset side, and therefore on the liability side 2200 minus the liability of 100, which is 2100, is divided in 3 partners in their PSR, so it is 700 each. So this is the fact pattern which is given to us. Now when Mr. X retires, we are told that he is going to get money, and when he gets money, he gets so money is B. So 45.4 is A is equal to B plus C minus D, and B is the value of money, which is 700. B plus C, C is the fair market value, the capital asset. In our illustration, is not getting any capital asset, so it is 0. D is the balance in the capital account. Now D is the balance in the capital account will comprise of what? 100 rupees, which is there in the capital account. But we have to remember that in the scheme of this act, there is that section 9B also. And the way the act and the scheme is drafted, you first have to see whether there is a 9B profit. Okay, now in this particular case, there is no 9B profit because neither stock in trade nor asset is transferred, and therefore there is no profit under 9B. Only cash is given, and therefore there is no profit under 9B. Had there been a profit under 9B, then that 9B profit is to be calculated, and the tax on that has to be minused, and the net profit after tax under 9B has to be added to the partner share. Because to that extent, that notional profits under 9B would increase the capital balance of the partner. And that is why I'm saying D is equal to D1 plus D2 for the sake of our understanding. D1 is that opening balance of 100. D2 is nothing but the share of profit on transfer of the asset or stock in trade to the retiring partners, which is that 9B profit, which in our case is 0. And that B plus C minus D actually gives you the capital gains under 45.4, which in this example is 700 minus 100, which is 600. Now, this is 45.4. Now we are told, we have to understand what is the tax on this 600. The tax on this 600 will depend upon how much of it is long-term and how much of is this short-term. The simplest way I would have thought is that if the partner is there as a partner for more than 3 years, everything should be long-term. Otherwise, everything is short-term. But no, they have given a formula, and therefore we have to go by that formula. So how much of this 600 is long-term and how much of this 600 is short-term is something which we need to understand. So that we understand by way of this attribution formula which is there in Rule 8AB. As you see in the first column is the amounts before retirement. This is all book values of 400. Something which is distributed on retirement is 700 by way of cash. Now we have to assume that this cash was not there, and therefore either the firm will borrow or partner will get in, the remaining partner will get in that cash, and that is how this cash will come in. And after retirement, therefore, the assets which are remaining. So what is the asset which is going? It's money. Now the attribution, we have to remember, the attribution will be on the assets which are remaining. So assets which are remaining are all the same except cash. All these assets are going to remain in the books of the firm, and therefore the attribution will happen to all these assets which are remaining. Now, what is the formula which is given for attribution? Okay, so let's go to that Rule 8AB as to how do you attribute. Rule 8AB says that for the purpose of 48(3), where the amount is chargeable to income tax as income of specified entity under 45(4), the specified entity, namely the firm, shall attribute such amount to capital assets remaining with the specified entity in a manner provided in this rule. So the attribution has to be only to capital assets, and therefore something what is not capital assets, you don't have to attribute. Now let's pause here for the timing and go back to that illustration. So here, what are the capital assets? Capital asset are these depreciable assets. Urban land, rural land is not a capital asset. It is outside the definition of capital asset. Goodwill, yes, it is a capital asset. Other current assets, yes, other current assets are also capital assets unless and until it is inventory, because capital asset includes property of every kind other than stock in trade and personal effects. So this is also capital asset. Money, there is nothing, and stock in trade is also not a capital asset. So really speaking, the attribution as per Subrule 1 should happen to only the capital assets, namely depreciable assets, urban land, and goodwill, and other current assets. If you just read the Subrule 1, the attribution of that 600 of 45(4) should happen over these 4 items. However, when you go to Subrule 2, there is a complication. It says that where the aggregate value of the money and the fair market value of the capital asset received by the specified person from the specified entity in excess of the balance in his capital account chargeable under 45(4) relates to what 3 items? Revaluation of any capital asset, or valuation of self-generated asset or goodwill of the specified entity. The amount attributable to capital asset remaining with the specified entity for the purpose of 48(3) shall be the amount which bears to the amount charged under subsection 4 of 45 the same proportion as, now this is important, the same proportion as the increase in or recognition of the value of that asset because of revaluation or valuation bears to the aggregate of the increase in or recognition of value of all assets because of revaluation or valuation. Please understand this proportion. So the amount of capital gain under 45(4) in our illustration 600, in the same proportion as the increase in the valuation of capital assets or goodwill, but the denominator is the value of all assets. Now, therefore, what do? I go back here and see allocation of 45(4), which is 600. 600 has to be allocated in, the ratio of E upon 1800. E is the revaluation amount upon 1800. Now, this revaluation amount is that numerator has actually to be the revaluation of capital asset. Numerator is capital asset and the denominator is all assets. Now, revaluation of all assets is 1800, whereas the capital assets are only 3. There are only four, that namely the depreciable assets, first item, urban land, second item. The rural is not a capital asset. Goodwill, yes, it's a valuation of goodwill, so therefore I will allocate it, and then I will also allocate it to 390, 167. Okay, these are the only three items to which I will allocate. So allocation does not happen to the rural agricultural land. Allocation does not happen even to stock in trade. Allocation also does not happen to the negative decrease in the other current assets, and in a moment we will see why that. So allocation happens to, sorry, one second. Yeah, allocation happens to the depreciable asset, urban land. It doesn't happen to the rural agricultural land. It happens to goodwill. It doesn't happen to other current assets. Why it doesn't happen to other current assets? Because 80AB2, if we read 80AB2, it says, which bears to the amount charged under 45(4) the same proportion as the increase in or recognition of the value of that asset. So we have to look at in the numerator only the value of increase in the value of capital asset. That asset over here is capital asset. So in our case, there is no increase, but there is a decrease when it comes to the other current assets. And therefore, when there is a decrease, there is no attribution. Okay. And that is how this 600 gets allocated only to these three items. It doesn't get allocated anywhere else. Now, so far as this 3 rupees is concerned, when it comes to 48.3, we are told that this will be reduced from the selling price as and when this depreciable asset is sold. Okay. In the same manner, this urban land, 90 rupees, which is attributed there. So as and when you sell this urban land, the sale proceeds will be reduced. And in the same manner, goodwill, if you sell this goodwill, then the sale proceeds of goodwill will be reduced by this 167, and you will calculate capital gains on goodwill after reducing this amount. So that what is taxed today, which is embedded in 600, will not be taxed tomorrow once again. Fine. Having said that, now you look at the bifurcation into short-term and long-term. Look, the entire 600 is the 45(4) gain. What is allocated is only these three items, and therefore under 8A5, 8AA5, let us see how they want us to determine how much is long-term and how much is short-term. It says that in the case of amount which is chargeable to capital to income tax as income of specified entity under 45(4) under the head capital gain, the amount or part of it, matlab the amount of 45(4) or a part of it, shall be deemed to be from transfer of short-term capital asset if it is attributable to ABC. Okay, now what are these ABC? Attribution to capital asset, which is short-term asset at the time of 45(4), that is at the time of retirement, or attributed to capital asset forming part of block of assets, or it is attributable to a capital asset being self-generated goodwill, etc. So something which is attributable to short-term asset, attributable to block of assets, or attributable to goodwill, it will all be deemed to be short-term. And what will be deemed to be long-term? The amount or a part of it shall be deemed to be long-term capital asset if it is attributable to capital asset which is not covered by one. So attribution is only to capital asset. If it is to these three capital assets, it will be short-term. If it is attributable to anything else, it will be long-term. Now you apply this, friends, and see how the attribution happens. We have this 600 ka capital gains comprising of, if I were to attribute to every asset, this 600 would get attributed in this manner, minus 20 to other assets, current assets, Depreciable assets 3 rupees, goodwill 167, urban land 90, rural agricultural land 60, stock in trade 300, total attribution is 600. Now, however, since the attribution is only to capital assets, and therefore there is no attribution to rural agricultural land or stock in trade. And when I attribute to short term, then the short term attribution is these three items: other current assets. Now, as I said, this 20, there is no attribution as such, because increase only has to be attributed, decrease has not to be attributed. But here, for the sake of understanding, I have taken this 20. So 150 of capital gain and 150 short term, 90 long term, that is 240 gets attributed. However, the balance 360 does not get attributed because it is rural agricultural land, which is not a capital asset, stock in trade, which is not a capital asset, and there is no attribution over here. And therefore, this portion of capital gain, that is 360, is neither long term nor short term. There is no way in which I can determine what it is, because the rules do not say. And that gives rise to this interesting question, that when this attribution is not possible, I cannot determine in law what is the character of this 360. If I cannot determine the character, how do I calculate tax on that? How much rate I will apply? Whether I will get any deductions or exemptions against that? How do I determine that? It is not possible to determine. And therefore, friends, the question is that if it is not possible to determine, can you take a view that the computation mechanism under the Act fails, and therefore the charge also fails? I can compute capital gains under 45(4), but I cannot compute in totality how much is long term, how much is short term. I can compute only to the extent of 150 and 90. Beyond that, I cannot compute this 360, whether it is long term or short term. So fine, I will pay tax of short term on 150, I'll pay tax on long term at 90. But so far as this balance is concerned, how do I pay tax? I cannot determine, and therefore computation mechanism fails, and therefore the charge fails. This is the proposition which I thought I should table, and therefore, can you therefore say that to the extent of 360, 45(4), although gets attracted, but in practice there is no 45(4) applicable on this item. I would, in my personal view, I would feel yes, you have a very strong case to argue this, and unless they amend the law retrospectively later on, I really think that there is a good case to argue that this portion is not taxable at all. So that was on 45(4). Are there any questions on this?
So the first question is, what if the firm has no other asset other than stock in trade, plots for builder, and retiring partner is paid in cash in excess of the balance in capital account, whether it is short term or long term?
Yeah, so if there are no capital assets remaining, then yes, there is no attribution anywhere. And in absence of attribution, I can't determine how much of 45(4) is long term and short term, and therefore everything goes tax free so far as 45(4) is concerned. Possible. Yeah, anything next?
So what would the capital gains arising and attributable under Rule 8AB(2) have any effect of deferred tax?
Okay. Effect on deferred tax under AS or NDS. Anyway, does not matter. So 8AB(2).
8AB sub-rule 2.
So, okay, what is the question? This gives the formula, proportionate formula, and what is the effect on deferred tax? So the partnership firm will, or the LLP will follow the accounting standards. Of course, NDS may not apply, but it will follow accounting standards to account for deferred tax. And what we are saying is that there will be some amount of this 45(4) which will be available tomorrow as a deduction in the hands of the firm when the firm sells that capital asset. And therefore, to that extent, you create a DTA today, and because that is the benefit which the firm is going to get tomorrow. So you might have to, yes, you might have to create a DTA for that. Correct.
So the next one is, what happens if no revaluation or distribution is made? Only constitution of firm changes by admission of partner with high profit sharing.
Yeah, so reconstitution is also regarded as change in ratio is also regarded as reconstitution. But however, 45(4) gets attracted when the partner receives, and he does not receive anything, then 45(4) does not get attracted. But if on reconstitution of the profit sharing ratio, if there is a chunk of withdrawal by the partner, then you might account it as withdrawal, but then that is arising as a result of his, as a result of the change in constitution, which ultimately is not an amount which is payable by him to the firm. It will not appear as a debit because he would have revalued that amount and increases capital, and then he takes that amount away. Then the same consequences would follow even if there is no retirement, because reconstitution includes mere change in the profit sharing ratio by definition.
Okay.
Yeah. Anything else?
Sir, there are a few more. How do you give effect to capital gain, which was kept aside for deduction from fair value of consideration received, if the deduction results in negative fair value of consideration?
So what we are told is that there will be a reduction in the sale proceeds. So if the reduction, it does not say it will be added to the cost. So if it adds to the cost, you might get indexation also, and you might be able to claim a loss also. But we are told that it will be reduction from the sales proceeds. Now, if it is reduction from the sale proceeds, which leads to a negative situation, then in terms of arithmetic, you should get a loss. But I do not think that is how it may function. You may not get a loss unless then in that case you may have to fall back on the rationale adopted by the special bench in Sumit Securities and say that this negative also makes positive. That is what Sumit Securities said, and therefore even though the law did not provide an arithmetic formula, in the case of slum sale in Sumit Securities, whereas in 45(4) it actually provides a formula. Okay, but then we are talking about a subsequent sale. You see, when from the sale proceeds of a subsequent sale, you are going to reduce this 45(4) element. The law says that that this attributed amount has to be reduced from the sale proceeds, and if it leads to negative, I think you should succeed to get a loss over there, especially because of Sumit Securities. Simply reading of the law may not be, but if you go by the rationale of Sumit Securities, definitely arguable that you should get a loss there. Yeah.
Okay. So the next one is, if the depreciable asset is always deemed to be short term as per 8AB rule, then there is a decision of Delhi High Court in case of Rajiv Shukla. Would that decision be rendered redundant? And can it be argued that the charging mechanism fails, therefore the charge also fails?
Okay. So Delhi High Court says what? Rajiv Gupta decision says what? Sorry, I'm not aware about that. Or maybe can you just read that question again, Kirti?
If the depreciable asset is always deemed to be short term under Rule 8AB, then will the decision of Delhi High Court and Rajiv Shukla be made redundant?
So is it something like Ace Builders and all, where and those Smita conductors and all, where we say that you will be able to claim, a lower rate of tax, you'll be able to claim 54 exemptions, etc. Now, if it is on those lines, here, because you have a specific provision in the rule which says that how it should be treated as long-term and short-term, then those lines of decisions, ACE builders and Smita conductors and those lines of decisions earlier, I think Guwahati High Court, then Bombay High Court, I'm not aware about the Delhi High Court, if it is on the same lines, which was on 54, etc., would be available even in case of a depreciable assets. And you had this Bombay Tribunal and Smita conductor, which say that even rate will be 20% in case of a depreciable assets. So effectively, you will not get only indexation, everything else will be available. Yes, if Delhi High Court is on the same lines, I think that that decision to this extent will not be a good law, right? To the extent of the depreciable assets being specifically deemed to be short-term here. Yeah.
Okay. So the next one is, would the capital balance for purpose of 45(4) formula include balance in contribution and partner's capital account, current account?
Sorry, come again, Ketki. Sorry, I missed you in between.
Would the capital balance for the purpose of 45(4) formula include contribution plus balance in current account?
Yeah. Current account is capital. You see, current account is a creation of accountants. The Partnership Act does not make a difference between capital account and current account. Yes, Partnership Act makes a difference between loan and capital. Because if you see the way in which at the time of retirement or at the time of dissolution of the firm, how the monies are to be paid to the partners, then there is a certain level of precedence given. And one of the precedents is loans to the partners gets a higher ranking as compared to the capital of the partner. So there is a difference between loan and capital, but there is no difference between current and capital. And therefore, I think current account will also be part of capital account. Yes.
So the next one is, would 45(4) apply when retiring partner converts his capital balance into secured loan with the same firm, and receipt would happen later over a long period based on the secured loan agreement? And what would be the tax impact of the secured loan agreement?
Yeah, so these are all peripheral issues and various issues of 45(4). So the question is, when it is converted into a loan, can you say that he has received the money, or you say that he has received the money only at the end of the term? I would feel that he has received the money when he converts it into a loan, because the capital has gone and the loan has come, it's converted into a loan, which is a debt. And more so if the loan would carry an interest, and loan would definitely be on a different footing as compared. So there is a constructive receipt, when this loan amount gets when the capital amount gets converted into loan, and therefore the tax could trigger at that point of time. Yes. So 194R. TDS on benefit perquisites under 28(4). So this is a provision which essentially says that a person responsible for providing to a resident any benefit will be required to deduct tax at source. Now, that benefit or perquisite arising from business or exercise of profession. The benefit of money either wholly in kind or partly in cash or partly in kind. And they say that if cash is not sufficient, you have to ensure that the TDS amount has been paid. And they have defined who is the person responsible for providing. And there are certain exemptions for smaller items less than 20,000 in a financial year. And we are told that the person providing is an individual HUF, and the gross receipts are less than 1 crore, or the gross receipts are less than 50 lakhs in profession, this provision will not apply. So this is by and large the provision. We are all aware about it. Now it's more than around 6 months' time has lapsed since these are introduced. So before dealing with items which are interesting and items which are debated and which creates controversy, even after the circulars, etc., have been issued, there are some principles that I want to highlight, which would actually govern the decision that we take on various examples that I have taken, after this slide. So benefit or perquisite should arise from business or exercise of profession. So this is an important term, arise from business or exercise of profession. This was also the term used in section 10.3, which said that, which now of course it's not there on the statute book, and 10.3 said that casual income is not chargeable to tax unless that casual income arises from business or exercise of profession. Now, in that context, you have a decision of the Supreme Court in Universal Radiators, where they interpreted what is the meaning of arise from business or exercise of profession. And reading of that decision gives us a clear indication that something may arise from business or exercise of profession has to be having a direct nexus or a first degree nexus from with the carrying on of the business or the exercise of profession. If there is no first degree nexus, if there's no direct nexus, then you cannot say that it arises from business or exercise of profession. This is also the principle which emerges from various dictionary meanings. If you look at what do you mean by arise from, and it actually means originate from. It is something like derived from in our ATI and ATIA cases. What is derived from? It is a first degree nexus. Okay, so if you look at the definition of derived from, also it says arise from, that sort of a thing. So there has to be it is almost synonymous to derived from. It has to be a first degree nexus. If there is something in between, then it cannot be regarded as arise from. If it's something incidental, it cannot be regarded as arise from. So this is one principle. Second principle is that you do something, you tax something if it is a benefit or a purpose. Now, if it is not a benefit or purpose, it doesn't fall under this section, and therefore you have to bear in mind the principle that if there is some obligation which is cast on somebody, on my business associate, then, and if he does that because it's his obligation, then it does not become his benefit or a perquisite. It is his obligation and it is compulsory for him to do it, or his business exigencies require him to do it, and therefore it doesn't become his benefit or perquisite. Clearly, an obligation is an obligation, it's not a benefit. That's the second principle I would like to put forth before this August gathering here. Then third is TDS is triggered before providing of benefit or perquisite. So if you have not provided for it, then there is no TDS arising. And finally, benefit wholly in cash can't be actually covered because the section talks about wholly in kind or partly in cash or partly in kind. So if something is wholly in cash, it cannot be covered. And that is also what comes out from various decisions in 28 under 28.4. However, CBDT seems to have taken a completely different view on the subject, and entire cash benefit is also regarded as covered under 194R. And therefore, I will not get into that debate. As of now, we will fight that matter as and when some fit case comes in and you would like to challenge the CBDT circular. So because of CBDT circular, even the cash perquisites will be considered as cash, as liable for 194R, whether it is partly in cash or wholly in cash. So therefore basically these three principles we need to just keep in mind. With this background, let's go to certain examples which come in our day-to-day life. Foreign trip or a local trip with or without spouse, if it is in the nature of an incentive and not a trip for business meeting or conferences. Now, business meeting conferences, your CBDT circular has clearly said that it will be outside the purview. If it's dealers conference and you're educating them on your products, etc., they've given some examples, so they are outside the purview. But if they are clearly in the nature of incentive, then the incentive trip, it may be incentive on turnover achieved or whatever, that 194R will apply. Now, as I said, this gets triggered at the time of providing the benefit, and not merely because you are passing an entry in the books of account. So take an example that I have booked a ticket. I have made a provision in the accounts for giving for certain certain benefits, because this is the policy of the company and therefore I made a provision. And in the month of April, I actually reverse that provision and actually provide the benefit to the concerned people. So the trigger does not take place at the time of creating that book entry, but trigger of TDS is when you actually provide the benefit, not provision in the books of account, but at the time of providing, means giving that benefit to that person. And this interpretation is also supported by the decision of Excel Industries, where where it says that that income does not accrue to a person, unless and until that was the case of your export benefits. And they said that even if the export benefits are credited to your DPP passbook, those export benefits do not become your income unless and until you actually utilize it. And TDS is after all what? TDS is after all is a way of collecting tax on your income. If there is income, there's TDS. If there's no income, there's no TDS. Okay, so section 4, which is the genesis of TDS, the charging section, says that income will be charged to tax, and the tax will be either by way of an advance tax or TDS, etc. So that is the genesis. That being the genesis, we have to look at what point of time the income actually accrues, and the income accrues at the time when the benefit is provided, and which is also the language of the section. So, so this is something as regards foreign trips, etc. So merely passing the entries in the books of account is not the point of time of taxation. Then second item, which was specifically one of the items of Mithai, which Abhidan and his team asked for, was brand building items. So you have situations where to your distributors, you distribute certain items where when the brand and the logos are mentioned, and those items can be like your boards, your billboards, your standees. You may also provide some stationery, some danglers, wall clocks. You may provide an ashtray where your name is written and you keep it there, so on and so forth. So these are the items which are prominently placed in the dealer's showroom. So question arises whether 194R applies or it does not apply to such items, because you may say that, oh, there is a wall clock which is given to that distributor, and that being the position, that's a benefit given to him, and therefore it should be charged to therefore there should be 194R. Now that is where this principle of obligation comes in, that at the time when you give this, you say that, look, you placed this particular item at a prominent place in your premises, and the dealer is obliged to keep it at a prominent place where the customers are going to come and go. And if he does so under an obligation which is cast upon him by the company, by the supplier, by the manufacturer. And when he casts an obligation, there is no benefit to him, and he is obliged under his agreement, or he is obliged under the terms and conditions that you give. I'm giving this to you on the basis of the understanding that you will place it on a prominent place in your in your showroom, and that being an obligation, arguably 194R cannot apply. Of course, your CBDT circular does not say about such things. Then we talk of training session and conferences. So company imparting training so as to ensure cordial customer relationship, give knowledge of the product to the dealers, enhances enhances the knowledge of the dealers, enhances the goodwill of the company. And once again, if remember in your communication, if you cast an obligation upon him to attend the training sessions, okay, you may bear the cost of the training sessions, but if you cast an obligation on him, then there can be no tax on that for sure. And to the extent of these training sessions and dealers meet where you are giving education about your products, etc., even the board circular supports that there would be no tax on, no 194R on that. So that is one argument. Loyalty points, once again, loyalty points per se, they are benefits, but loyalty points are benefit Are these benefits arising in the course of business or profession? One has to see. So say, for example, I'm a credit card user and my banker, because I'm using his credit card, I've used a particular level of credit card. And therefore he gives me certain loyalty points and says that, all right, you can use this loyalty point. You can go to Metro Shoes and buy shoes. You can go to so-and-so shop and buy so-and-so material and you get 10% discount, or you get certain items free, or whatever it is. So when I get certain items free or I get a discount, definitely there's a benefit or a perquisite to me. There's no doubt about it. But is that benefit or a perquisite arising in the course of business or profession? How can a banker or an airline ever find out whether this loyalty points credited to the account of Yogesh Thar are the loyalty points arising out of his business or profession, or they are just arising out of because he has consumed his personal, he has used his credit card, or he has traveled for his personal visits, and therefore these loyalty points are given to him. It is absolutely impossible for anyone to even guess whether these are arising out of business or profession or not, and therefore the threshold that that the benefit of perquisite should be arising from business or profession, that threshold or the examination of threshold fails. It is impossible to find out, and therefore the section also would fail, and you cannot really apply these two loyalty points. Then the next one is providing free samples. Here again, one has to be careful that free samples are provided with an obligation that, okay, you provide me a report on the efficacy or acceptability in the market. You are not liable to sell it, and whatever is unused, you return to me. Okay. So therefore, I'm casting an obligation on that person that these are the obligations. I'm giving it to you because you are my dealer. You are in touch with the market. You are in touch with the ultimate consumers, and therefore this is the feedback that I want from you. And if for any reason you have not used it, you please return it back to me. If that is the case, then on first principles, this is an obligation and not a benefit, and there cannot be any tax. Now, the CBDT circular gives an example when it says that if on buy one get one free type of a thing, so you get more number of items and you treat it as a discount in your bill, then there'll be no tax. But but then it says that if you are giving it as free samples, 194R will apply. So there's a controversy created by the CBDT circular that while on first principles, if you are casting an obligation, there cannot be any TDS obligation, it cannot be any benefit. However, because of the CBDT circular, the tax department will definitely treat it as your failure to deduct 194R and take action against you. So therefore, for all practical purposes, fall in line with the CBDT circular and structure it as a discount, add those free items in your bill, which they say that it effectively reduces the price of the bill, price of the item, and therefore it is in the nature of discount. Discount ultimately is defined as reduction in the price of goods. This is how the definition of discount is in terms of, if you look at, guidance note of terms used in financial statements issued by the ICAI, or you look at any definition of discounts anywhere, you find that this is the underlying, that reduction in the price at which you are selling is a discount. And therefore the CBDT circular says that, look, if you are structuring at a discount, 194R does not apply to you. So I think rather than getting into this legal battle, if you are able to structure all your free samples as a discount, I think you are on a safe wicket. But if you can't do that, in terms of legality, I would still feel there is no 194R, but certainly there could be litigation if you're not structuring it as a discount. Then there are various items, there are various items of promotion of SSE companies' products. So putting up a name board on wholesalers, retailers shop with the company's name and logo along with the dealer's name. putting up any type of machine at the wholesalers or retailer shop free of cost or free of rental so that he can sell the products of the company. Then providing any other material product catalog to the wholesalers, retailers, expenses incurred by the company for sharing of shop renovation, painting expenses of wholesalers. So, I may undertake renovation or I may undertake painting of their shop. Cost of company's technical personnel deputed to wholesalers, retailers shop for resolving customers' queries and promoting company's product, and giving performance-based gifts. So of course, this performance-based gift definitely 194R applies. So this should actually not be considered as part of this block. So let's consider this block of A, B, C, D, and E as one block. Now here you can invoke this theory of obligation once again, that in the contract with the wholesalers, if these sort of things are shown either as a right of the company or the obligation of the retailer, that look, you're obliged to maintain certain standards in your in your company. You need to have certain type of furniture. You need to have certain decency in painting, etc., because ultimately it is the goodwill of the supplier which will be affected, because you as a dealer are the front face of the company as a company as a manufacturer, and therefore all these affects the goodwill of the company, and therefore I undertake that I will supply you with certain furniture, or I'll paint your walls, or I need my logo to be there, and therefore along with my logo I paint the board for your logo also, I paint your board also, and so on and so forth. And so therefore you cast this as an obligation either under your agreement, or you cast this as an obligation by your separate letters to the dealers, and therefore that does not become your benefit, and you're out of 194R. Put items like this in the contract by stating that it is essential for the purpose of reputation, goodwill, etc. So this is a principle you can invoke in these type of items. Gifts on performance-based gift, definitely 194R applies. Now, gifts on festivals or occasions. This is also an important question which arises every now and then. Here, arising from business, is the gift on festivals or occasion, can that be regarded as a benefit arising from business or exercise of the profession? So is there a direct nexus between the transactions you are doing and this gift, or it is only a second degree nexus that, okay, I'm doing a transaction with dealer Mr. A, and this dealer Mr. A is a good man. I need to appreciate him by way of giving these gifts, or I need to express my gratitude to him by way of giving these gifts on Diwali, on Christmas, etc. So I would feel that these type of gifts are the gifts not arising from, because there's no first degree nexus. They're not arising from business or exercise of profession. They have a second degree nexus, if at all. And certainly you should not have a scheme of a company to say that, to all these dealers, I will give this gift. It has to be a voluntary amount that you're going to give, or voluntary gifts that you're going to give. Don't make it as a policy. If it's a policy, then there's an expectation on the part of the dealer, and if there's an expectation on the part of the dealer, yes, it gives rise to the theory that there is an implied contract, and then it can be regarded as some sort of a requisite chargeable to tax under 194R. Conferences organized by the company to educate a section of society in respect of certain products. So it's not necessary that I am organizing these conferences for my dealers. I may be organizing, so say for example, there's a company which is a food company, and it has certain nutritional values in the food, and therefore it organizes conference of say doctors, and invites doctors to attend it, to say that, okay, these are the plus points of my food, or these are the nutritional values which which one should take care of, you as healthcare professionals. Now, There is no contract whatsoever between this company and those healthcare professionals who attend these conferences. And therefore, this is not arising from the business or exercise of their profession. There is no first degree nexus between the company and these entities. Here also, once again, that 10.3, that Supreme Court decision rendered in the context of casual income will throw more light on this, that what really is covered and what is not covered in arising from business or exercise of profession. So my view here is that these type of conferences, which are somewhat remote, somewhat removed from the immediate nexus of business. If you're giving to dealers, it may be a different thing, but if you're giving to a society at large or a certain section of the society at large, then you are only increasing your goodwill. You are only increasing your reputation and your spread in the society, which I think is not in the nature of benefit arising from business that it can be chargeable to 194R. So I think that is on 194R. We may take a few questions.
One is, will issue of bonus by private company be liable to 194R?
Bonus shares?
Bonus shares.
No, issue of bonus shares can never come under 194R. First of all, it's not arising out of business or profession. Holding my share as such is not. But even if assuming that it is stock in trade, it cannot be, because bonus shares will result in fall in the value of original shares. That's the theory that you have to take note of. And therefore, bonus per se is not income. That is a very settled position. So, because when the bonus is issued, it is not coming to you free. You are paying for it because there is a fall in the value of your original shares.
So then we've already covered, but then the questions are on similar lines, whether incentives, gold coin on achieving sale targets.
Yeah, they are all covered.
We have all covered that. And the last one was a little big one. FMCG companies run promotional loyalty points.
Yeah.
And for each product, they give 5 points, and people accumulate such points. And then the award is the amount huge value is awarded. And if 10 people accumulate, and whether that be in compliance of 194R.
No. So if those points are to, say, for example, a company selling some item in a box, and in that box there is a small coin or reward point, and those reward points are getting accumulated, and one fine day you go and encash it, then certainly it is arising out of your business or profession. Certainly it is a perquisite or a benefit, because you are his dealer, and you a dealer or a consumer. You are, so long as it is for the purpose of your business, definitely that those loyalty points would be chargeable to tax as in when you actually utilize it. Okay, but if there is no such nexus, so loyalty point, the example that I gave of bank and airlines, there is no way of finding out that it is arising out of business or profession. And such type of loyalty points cannot be. But what you are saying, if it is directly connected, you are providing this something to your customers, then and those customers are doing business with you, or doing business for you rather. If it is provided to an end consumer, no, it is not arising from the business or profession. But if it is provided to a dealer or a distributor, answer is yes.
So the next one is whether it will be applicable to a charitable institution running a hospital.
A charitable institution gives benefit and perquisite to public at large as charity, and therefore that is not income per se. And if it is not income per se, 194R can never apply. So the benefit is received by public at large because it's a public charity. Okay, but suppose that charitable institution has a contract with some doctors. Okay, is a hospital and it has a contract with a doctor, and And there, as a contract to the with the doctor, it pays certain perquisite or it allows certain amenities to the doctor. Then yes, 194R would apply in that case, because otherwise also you are deducting tax under 194J when when you are paying to that doctor. And this element is this perquisite arising to him would be chargeable in the sense, and therefore 194R. So you can't have one answer. It is depending upon the benefit is flowing to whom. Is the benefit flowing to the society as large, you being a charity, or is the benefit flowing to some party with whom?
Sir, I had one question regard to ARCs. So an ARC, asset reconstruction company, buying a loan at a concessional rate, so 100 crore worth of debtors bought at 30 crores from the bank.
Yeah.
Can by any imagination it be said that there is a benefit to the bank and therefore I should deduct TDS on that?
No, because it's a reduction in price. Again, first of all, it's under first principles, all discounts are out because they are in the nature of cash, and therefore this section can never apply. Secondly, even within the board circular, this is in the nature of a discount which is given to you by the bank who is selling you this receivable, and you're buying it at a bargain price. And when you're buying something at a bargain price, it is in the nature of discount, and there's no benefit at that stage.
Thank you. Ketki, any other questions?
So just one last one, whether the benefit giver has to be engaged in the business of business or profession?
Yeah.
The provider of benefit.
Provider of benefit.
The provider of benefit need not be, but you see, but how would something arise from somebody's carrying on of business? Yeah, it is possible. I as an individual am availing services of Ketki Mittal, and I'm paying her a particular amount by way of professional fees, and I'm also paying a perquisite to her. Then yes, it is, so far as the professional is concerned, it is arising out of business or profession. But so far as I'm concerned, I'm just availing of my personal return services, suppose. But then yes, it would still be liable to tax. So it's not necessary that the provider of service should be in business or profession. No, I don't think that there is anything in the section for that, to that effect. So a somewhat topic nearer to 194R, 37(1). So explanation 1 inserted: expenditure incurred for the purpose which is an offense or prohibited by law. Now we are told that this particular phrase which was there in the old explanation will have three parts of it: purpose, which is an offense under which offense or which is prohibited by law. Then they've added in India or outside India. Then provide benefit of purpose in acceptance of such benefit in violation of any law or rule or regulation, or guideline governing the conduct of that person, and to compound an offense under a law. So these are the three parts which the original explanation 1, they are saying that now that original section actually comprised of these three things. And so the explanatory memorandum says that something which is not intended to be allowed under this section has been allowed, and then they discuss the background with case laws, etc. So then after this amendment, we have this decision of the Apex Laboratories dealing with doctors' payments or doctors' perquisites. And the argument of the SSC was that, look, these MCI regulations would apply only to pharma companies. It applies only to medical practitioners. These regulations do not apply to pharma companies. So far as the doctors who are taking these benefits, they may be violating the regulations, but I as a company, the regulations don't apply to me, and therefore I am not violating, and therefore don't apply this. And therefore, so far as I am concerned, the payer of these benefits, there is no violation of law, and there is no question of disallowability, and it is for the purpose of my business and your law. So Supreme Court says, no, nothing doing. Something which is prohibited by law for A is also prohibited by law for Mr. B, whether that Mr. B is specifically covered under the law, or under those regulations or not. If A cannot take, B also cannot give. So that is the theory under which the decision came. And therefore, whether you have this amendment which has happened, whether it is retrospective, not retrospective, ultimately, Supreme Court has held that these benefits are not allowable at all after considering all those past decisions. Taking that into account, now in future, if I have to still either defend my old cases or take a view on what is there any way to salvage this particular situation? Is there any way in which I can save some of my expenditure from this complete disallowance? So that is where this journey starts of looking at a possibility of mitigating this risks of entire disallowance or salvaging some of the expenses from disallowance. So in this journey, we come across a principle laid down by quite a few decisions of Supreme Court, but this A.K. Menon is something which is worth noting, which says that the authority entrusted under the concerned statute or a law alone can determine or adjudicate the violation of that law or liability or consequences thereof, and no other authority can do so. Okay, this is the principle which has been laid down over here. So now apply this principle to your 37(1), which says that you have made certain payments to doctors. I, as an assessing officer, am of the opinion that these payments or these expenses violate the MCI regulations, and therefore I will not allow it. I, as an assessee, say that no, I have not violated any regulations. Look, this is the interpretation of mine so far as these expenses are concerned. And look, no authorities under the MCI regulations have ever taken any steps against me. Who are you to take step against me? Who are you to decide that there is a violation of law? If there is a violation of law, it is the authority under those regulations who has to decide. And therefore, you can't sit in the armchair of that authority and say that there is a violation and therefore I'll disallow. This is a principle that is definitely supported by various decisions, this is a principle which needs to be looked at and invoked, at least to salvage something which is a debatable issue under the MCI regulations. Now, the decision of Supreme Court in Apex Laboratories has actually gone on the footing that there is a violation. There's an admitted violation. Department says there's a violation. SSE does not dispute that there's a violation. SSE says that, boss, look, rules do not apply to me. Rules applies to a doctor. So violation hoga to doctor ka hoga. There's no violation on my side. That was the basis on which this case was argued. And that is the basis on which this decision has been arrived at. There is no argument whatsoever or stand taken by anybody whatsoever, because they both admitted, the SSE admitted that there is a violation, but it is not mine. So there was no question before the court that who has to decide whether there is a violation. The question would arise only if the SSE says that there is no violation. Then who has to decide that there is a violation? And then comes the question that it is the authority under that law who can decide that there is a violation. If he decides there is a violation, you go and disallow the item, I don't care. So invoke the principle laid down by the Supreme Court in Sun Engineering, which says that the decision of a court is the authority for the question which is raised before it. And it can't be an authority on all situations. So you read the question which was there. That is what has been examined by the court. If a particular question is not there, which is not examined by the court, to that extent, it is not the authority. That in all cases, there will be a disallowance, right? So applying this principle, friends, applying this particular line of reasoning, one may possibly argue, at least on certain items like free samples to doctors, or certain items, as we discussed, items which are less than 1,000 rupees, where MCI regulations itself says that there will be no consequences if these gifts item are less than 1,000. But at the same time, you have certain earlier decisions where they say that these are only product reminders, these are only advertisement value, and therefore they are not in the nature of benefit. They do not they fall outside the scope of MCI regulations and so on and so forth. So if you so I think this is a principle. I'll not get into each and every type of the expense which is possible in this. But certainly there are expenses, and a large chunk of it would be free samples. And please note this, that in fact free samples to doctors is something that the Drugs and Cosmetics Act actually permits. There's no prohibition; it actually permits. It says that you can give this, provided you write over there that this is a physician sample not to be sold. Now, if that is what the Drugs and Cosmetics Act says, then where is the prohibition in law? There is in fact permission in the law that you can do this provided you write over there. So this is not something which is prohibited by law, and therefore you cannot disallow. So, so therefore one has to make out a case depending upon the nature of his expenses. Of course, clearly if you are given Malaysian a tour to Malaysia or Indonesia or a tour to Mauritius, to your doctors and to their families, you would stand on a very different footing or a weak wicket. But if there are expenses which are something which are not really in the nature of gift, they are small items, or they are items which are product reminders, which you are saying that, okay, I'm putting it on your table, please let it be over here for when people come and visit you. So it's a reminder to you, that's all. So those sort of samples are those sort of items probably can still fall outside, especially when the SSC says that I'm not violating the law. Assessing officer is saying that I'm violating the law, and therefore we say that you are nobody to decide that whether I have violated law or not. You write to the MCI and let MCI say that I have violated the law, and then you say that okay, penalty is levied, or then you say that this allowance is there or it's not there. So this is an area which needs to be argued in a fit case. Please look at your facts before arguing these matters. If you have got bad facts, it will give you a bad law. If you have good facts, it might give you a good law. Then, of course, 37 has very expanded wings implementation in case of a foreign law. So vendors of goods or services, undertaking that they are not prohibited by any law from dealing in such goods or services in their home country or anywhere else in the world is something which you'll have to think of. That you take some sort of an undertaking, because you cannot really decide on foreign laws sitting over here. Ignorance of law is not an excuse, but ignorance of law means the Indian law. Ignorance of a foreign law is not an excuse, is probably not tested anywhere. And therefore you take an undertaking from all your foreign suppliers or customers that they are not violating anything. Then you have then what is law? The law may be statutory law or a judge-made law. In every case, therefore, to be law, it must be a creation of a formal source, either legislative or judicial authority. A statement by a person or a body not competent to create or define a law cannot be regarded. But now they have extended the wings over here, and they have said that not just law or rule or regulation or guidelines. So when the word law means a statutory law or a judge-made law, and then it also includes statutory rules also, but then you are saying rules or regulations or guidelines. It would really imply that all your private rules and private guidelines and all your codes of conducts, if by a code of conduct of a particular vendor he cannot charge something or he cannot do something, and if I have incurred an expenses for this, then I am violating his internal guidelines, and therefore I'm covered under the spreaded wings of 37(1). So therefore, it is advisable to have a clause in all your contracts with all your vendors and customers, giving representation as regards their internal rules, regulation, codes of conduct concerning acceptance of freebies, etc. It is advisable to have as a procedure proper documentation from the website of the vendors, customers, especially their internal code of conduct and things like that. Then clause 3 says that compounding of an offense. So you need to know that what is compounding of an offense. Actually, compounding of an offense is not prohibited by law, it's permitted by law. That you can compound this offense. So that is what the law actually provides. So how can compounding be an offense? How can compounding be something regarded as prohibited by law? It cannot be. Therefore, compounding fees cannot be. But now they have brought it within the scope. So here we need to understand that there are things like consent orders, especially when it comes to SEBI, that there is an allegation by SEBI that you have violated some law. Okay, then I enter into a consent decree or you consent order and pay a certain amount towards that consent order, saying that okay, I do not admit an offense, I do not deny an offense, but however, I am paying this amount as a settlement under a consent order which is agreed upon. So consent order is not compounding of an offense, because if you look at the FAQs which are issued by SEBI, they say consent order can be passed at any stage where probable cause of violation has been found. In the event of a serious and intentional violation, the process cannot be completed till the fact-finding process is completed, whether by of investigation or otherwise. So consent orders are much before the offense is actually proved. And therefore, when something is paid in order to buy peace and save time and save costs in future, that payment under a consent order is not compounding of an offense. And therefore, arguably, that cannot be something which is not allowed under this provision. You do have a decision of the Mumbai Tribunal, Reliance Shares and Stockbrokers on this particular topic. Of course, this was much prior to the amendment which came in, but I think this consent order issue would still survive. That this is not something which is compounding. It is not compounding. It's not, therefore, not covered under the prohibition over there. So these are the things which I thought I would discuss in 37.1. If there are any questions on this, we can take it for 5 minutes and then move ahead.
Just one. Can compounding fees paid under 279 2 of the Income Tax Act be disallowed under 37.1?
It cannot be regarded as independent of 37. It cannot be regarded as for the purpose of business. So therefore, I have doubts on that it is not for the purpose of business as such.
So then we can proceed.
Yeah. So non-compliant conversion of company into LLP. Okay. So not a small point, because the small point which keeps on coming every time on this conversion of LLP, especially because of the decision of the tribunal in the case of Subsidiary. So what are tax? So there are 3 entities we have to look at: tax implications under the company, tax implication in the LLP, and the implications in the hands of the shareholder who has become a partner in that LLP. So we are saying it is not non-compliant with 47.13b. Some conditions are not satisfied. What happens? So strict legal view, which I still believe is a correct legal view, is that there is no transfer. Okay. However, Celerity says, I think this Celerity's citation as 4th bullet point over here is wrong. Celerity says that there is a transfer. They have in fact made a distinction between tax spin, which was under the Part 9 of the Companies Act, and the LLP Act, and they said that here there is a transfer. So there is a transfer. The second question is, okay, if there's a transfer, is there a consideration? Really, there is no consideration received by the company, because the company actually dies. The consideration goes to the shareholders. Yet, however, somehow Celerity and this Om Chemicals have taken a view that the amount recorded in the books of account is the consideration. And then simplistically saying that what is recorded in the books of account is nothing but what you are carrying in the balance sheet. Therefore, the question of profit does not arise, and therefore nothing is taxed. So therefore, questions keep on arising that, okay, if we transfer it book value, what happens? Is there a consideration? Is there a tax implication in the hands of the company or in the hands of the LLP, etc.? I would feel that there is no consideration which is received by the company. Company actually dies. If at all there is a consideration, it is received by the shareholders and the shareholders who have become partners in the LLP. And there could not be any tax implications in the hands of the company. Yes, it is advisable that you comply with the celerity decisions, do it at book value so that you don't enter into controversy at all, and don't get into a legal fight whether there is a consideration or there is no consideration otherwise. So that as of today, that makes the task easy so far as the company is concerned. So far as LLP is concerned, there is no transfer on the part of LLP. LLP is actually receiving. And what is it receiving? It is receiving an undertaking or a business. And an undertaking or a business, if it a property which is received at less than fair value, then only the question of taxability in the hands of the recipient will arise. Otherwise, there is no taxability in the hands of that person who is receiving that undertaking, and he is actually paying consideration for it. So therefore, you have to look at only 56.210. Is there any tax on receipt? Now, what you are receiving undertaking. Now, 56.210 applies when you are receiving certain defined properties. Those properties include immovable property, land, immovable property, share securities, artwork, etc. That definition of property does not include a undertaking of business, and therefore receipt by an LLP of an undertaking. It will not fall within the purview of 56.210. Because it's not property as defined under that section. And that therefore takes us to the last and the important question: is there tax implication in the hands of the shareholders? Answer probably is yes, that the shareholders are becoming partners in the LLP, and you are not entitled to exemption under 47 because 47.13b exempts the company also and LLP also. Company also and the shareholders also. But that exemption is not available, and therefore there is an exposure in the hands of the shareholder. Now, what is that exposure? Is there a transfer, first of all? Yes, there is a transfer because the shares in the company are getting extinguished for the rights of a partner in the LLP, and therefore there is a transfer. Is this transfer an exchange? Probably answer is no, it is not an exchange, because exchange would really mean that both should exist at the same time. Here, the shares in the company are getting extinguished, and the right in the LLP comes into existence, and therefore it's not an exchange. But nonetheless, there is an extinguishment of an asset, and that by virtue of extinguishment, if you follow the decision of Supreme Court in Grace College, there is a transfer. Second question: is there a consideration received by the shareholders? And there you have this principle laid down the Supreme Court in Sunil Siddharth by that was a case where the partner is introducing his property into the firm and getting a share of profit. Supreme Court said that what the person is getting is something which I cannot value today, because he's getting a share of profit in the future, and therefore the consideration lies in the womb of the future, and therefore there is no consideration which can be determined today, and therefore the charge fails. If the consideration fails, charge fails. That was the principle which was laid down here. Now, if you follow that principle, certainly there is no tax in the hands of the shareholder, but today that principle does not survive because you have section 50D, which says that if the consideration is not determinable, then you look at the value of the asset which has been given up. Now, the asset which has been given up are the shares, and therefore you look at the value of the shares. And if you look at the value of the shares, you have section 50CA to determine the fair value of those shares, and therefore you take section 50CA valuation to determine what can be the tax liability in the hands of the shareholder. According to me, beyond this, there cannot be any tax liability. And if for any reason the 50CA valuation is fairly reasonable, you can bear that cost, then probably I don't think that there can be any other levy in case like this. But if you have got large immovable properties, maybe this may not work in those cases. So this was a small point which I thought is important in the case of non-compliant conversion. Yeah, any queries on this?
No, sir, none.
we move forward. All right. Or loss of investment in the subsidiary, whether allowed. Now, if a company has investment in a subsidiary, then there are two ways of looking at it. That I, as a company, am engaged in the business which I'm carrying on myself, or I'm carrying on the business through that subsidiary because I've invested in that subsidiary and it is doing some business. And therefore, the shares of those subsidiaries are my business assets, and therefore the profit or loss in those shares is a business loss or business profit. This is one way of looking at it. The other way of looking at it is what? Yes, I have investment in shares of a subsidiary, and therefore I have a controlling interest in that subsidiary. Maybe that subsidiary is doing some business and I am controlling that business, I being the holding company. And in fact, I acquired those shares to acquire control over that company. And therefore what? Therefore, you look at this decision of Supreme Court in Ramnarayan and Sons case, where this company had acquired shares of another company to acquire the managing agency. In those good old days, there used to be managing agents of the company, which system, of course, is now not there for the last 5 decades. So maybe more than that. So this system of, so I acquired the shares of a company to acquire a managing agency, and that managing agency is going to give me a regular revenue. And therefore the SSE over there probably argued that the loss arising, out of sale of those shares is a business loss. The Supreme Court said, no, boss, you acquired these shares to acquire control over this company. You did not hold these shares as your stock in trade. You did not want to circulate this stock, to sell it and get money and buy another shares and then sell it and get money. It was not part of your rolling stock. It was not part of your fluctuating capital. It was part of your fixed capital. You were holding those shares as a fixed capital, and therefore it cannot be regarded as stock in trade. You have, so a company, the shares of a company which you are going to control. So shares held with controlling interest are not stock in trade, and therefore profit or loss on sale of those shares are not in the nature of capital gain, are not in the nature of business profit or business loss. They are in the nature of capital gain or capital loss. So this was the principle laid down in the Supreme Court in Ramnarayan and Sons case. Now, interestingly, before that, you also have a decision of Madras High Court in 92 ITR, which was not concerned with the sale of those shares, but diminution in the value of investments. And Natarajan Madras High Court said that this diminution in value of investment is not allowable. It is allowable only if the actual loss is incurred. Merely on diminution, there can be no loss allowable. So that loss, whether it is business or whether it is capital, will depend upon whether it is holding a stock in trade or whether it's a capital asset. But merely on diminution in value of investments, no loss is allowable. If it is stock in trade, yes, diminution in value will be allowed because stock has to be valued at cost or market value, whichever is lower. But if it is held as capital asset, then that diminution is not allowable. So this is another principle. Now comes an interesting twist in the tale that you have a decision of Supreme Court once again in Patnaik and Company, and I'll just read out. It held that the loss arising on disposing of certain government securities was a revenue loss. Now, this was so held on the ground that the said government securities were acquired with a view to acquire business from the government agency. It was held that such securities were held for the purpose of business, and hence the loss on sale of such securities was a loss allowable in computing income under the head business. Now, this is Patnaik and Company. Interestingly, for the timing, you may note that this Supreme Court decision in 161 ITR, does not have any reference whatsoever to the decision of Supreme Court in Ram Narayan and Sons case in 41 ITR. Not referred to. Without considering Ram Narayan and Sons, there it was case of acquiring shares for acquiring managing agency of a company. Here you are acquiring government securities with a view to acquiring business of government from a government agency. Both are almost pari materia. Yet in the earlier decision, Supreme Court said, no, it's on capital account. Here the Supreme Court says, no, it's on revenue account. Two apparently conflicting decisions. The subsequent decision does not take note of the earlier decision. Now, the story goes further interestingly that following Patnaik's case, Karnataka High Court in ACE Designs has taken a view favorable to the SSE and has held that the loss arising from write-off of investment. Now here it's write-off, not even transfer. Write-off of investment made in its wholly owned subsidiary outside India was an allowable business loss in the hands of the holding company. Of course, Karnataka High Court has not considered Ram Narayan Sons, not considered Madras High Court in Natarajan's case. Following Patnaik's case, it has held that this is an allowable business loss in the hands of the holding company. Karnataka High Court has relied on Patnaik's case and it has also relied on a Bombay High Court decision in Colgate-Palmolive. Interestingly, 370 ITR Colgate-Palmolive decision. Now here, Colgate-Palmolive had a subsidiary. Colgate-Palmolive was manufacturing toothpaste, subsidiary was manufacturing toothbrushes. And those toothbrushes were entirely acquired by the holding company and then they were sold by the holding company. So practically that subsidiary was an extended arm of the holding company. And looking at those facts, the Bombay High Court held that it is entirely for the purpose of your business. It's sort of your captive unit, and therefore the shares held in that subsidiary, which is nothing but your extended arm, it's your captive unit. The shares held in the subsidiary are on capital account, are on revenue account. It is for the purpose of your business. If you have incurred a loss, we will allow you that business loss. Once again, Bombay High Court has not noted Ram Narayan and Sons. On the similar lines, you have Rajasthan High Court in Wipro Global 138 taxman.com, where it is diminution in value of investment in a subsidiary. Bombay High Court, Colgate was sale of the shares. Rajasthan High Court, even diminution in value of subsidiary is an allowable revenue loss. I mean, something which is mind-blowing. These are the decisions which are there. And similar, you have decisions of Delhi Tribunal in Cosmos, in Sahara Global, and a Mumbai Tribunal in Manish Pharmaceuticals, which they have taken a view that even write-off is an allowable expense. Now, what is right, what is not right, what one should do? As I said, interestingly, none of these decisions are considered Ram Narayan and Sons, nor considered Madras High Court. And what is important to note, which not come out in the slide, is that Ram Narayan and Sons is a decision of 3-judge bench. And the decision of the Supreme Court in Patnaik and Company is a decision of 2-judge bench. So therefore, the larger bench will always prevail over the smaller bench decision, especially when it has not considered larger bench and distinguished it. So therefore, to my mind, despite all these decisions in ACE Designers, Colgate-Palmolive, Wipro Global, blah, 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 forget diminution in value of investments. Even the loss on sale of shares cannot be regarded as business loss. According to me, it would be capital loss. Now just imagine, friends, if you want to claim loss as a business loss, you apply it to profits, what is going to happen? All your holding companies holding the shares of subsidiary companies, right? When they sell those shares, when they divest, you will see, tax department is going to say that what capital gain, this is all business income for you. It is unstatable, according to me. And in fact, you have a Bombay High Court in Accra Limited or something. I don't have that citation handy right now, which has followed Ram Narayan Sons. Accra has followed Ram Narayan Sons and has held that the profits are capital gain. Now, in that particular case, the department had treated this as business income. In ACRA, it had a subsidiary for a holding, which was having controlling interest. It was not even a wholly owned subsidiary, but it had a substantial chunk which was transferred. The department said it is your business income because it's that subsidiary. You are actually doing business through subsidiary. Matter reached the Bombay High Court. Bombay High Court, it was argued that Ramnarayan Son says that even if you are acquiring shares, wherever you are acquiring shares for having controlling interest in the company, it has to be on capital account, not on revenue account, and therefore the gains have to be treated as business income. And you have that decision of the Bombay High Court. So once again, Bombay High Court, in a case of Colgate, taking a different view, ACRA taking a different view, because in both the cases they have followed two different Supreme Court decisions. To conclude my view on the subject, whatever the controversies are, but I think there is really speaking no controversy, because you have a larger bench decision of Supreme Court in Ramnarayan which says that it's on capital account. Following that, I guess that the profit or loss on sale of investment in a subsidiary will have to be on capital account, not revenue. But yes, you have these decisions, and therefore, in fit cases, one may like to take advantage of it. It's a different matter. So let's look at the impact of Wipro's Supreme Court decision. What does Wipro say? 288 Taxman 491, it's a recent decision, where you have section 10B, which provides an exemption to export-oriented units. And there is this subsection A, which actually says that, look, if somebody does not want to claim 10B, then he has to file a declaration that I don't want 10B, in which case he will not be allowed 10B. But that declaration has to be filed before the due date of 139(1). Now, in Wipro, what that SSE did was, in his 10B unit, actually there was a loss. So in his original return, which he filed before 139(1) due date, he did not claim that loss. And he said that my 10B unit is entitled to 10B. He did not claim the loss. Then he had some change of thoughts, filed a revised return, and said, no. I'm claiming that loss as a carry forward loss, and I don't want 10B. And here is my declaration that I don't want 10B. The assessing officer said that, boss, this declaration has to be filed before the due date under 139(1). Now I will not accept this declaration. The SSE says that section 10B requires me to file a declaration. So I have filed a declaration which is mandatory. But before the due date of filing the return of income under 139(1) is only directory and not mandatory. And therefore, so long as I file a declaration in the course of assessment proceedings, you should allow me. And for that proposition, it relied on various decisions rendered in the context of filing audit reports, etc., and argued the matter. Supreme Court said no. Section very clearly says that the declaration has to be filed before the due date under 139(1). You haven't filed a declaration before the due date, and therefore this declaration is not valid. If this declaration is not valid, it's your bad luck that there was a loss under 10B. And if it was an income, we would have given you an exemption. But if there is a loss, that loss cannot be allowed to you to be carried forward. And exemption provisions will have to be strictly construed. If it says that you can opt out in a particular manner, you can opt out only in that manner. Now, in that particular argument, the senior counsel arguing the matter pointed out the earlier decision of Supreme Court in GM knitting. GM knitting was a case which dealt with which in fact dealt with two situations, two sections which provided for filing your audit report or filing a certificate along with the return of income. And that was section 80 IB and 32(1)(2)A, which required that you have to file something along with the return of income. And I have filed it not along with the return of income, but in the course of assessment proceedings. So Supreme Court approved the various high courts principle that this along with the return of income is only directory and not mandatory, so long as you give it in the course of assessment proceedings, because return of income is not a point of time, but return of income is something which is an entire process of assessment, right from the date of filing till the date when the assessment is made. So long as you give it in the course of your assessment proceedings, it has to be allowed to you. It has to be regarded as along with the return of income, and therefore these words will have to be words that it has to be filed along with are actually only directory. They are not mandatory. We will allow you this we will allow you the benefit of these deductions, even if you file these audit reports in the course of assessment proceeding. Now, this case law was pointed out by the counsel arguing in Wipro, and Supreme Court somehow distinguished this. The way it has distinguished it, that it had certainly this case law is distinguishable because unlike 10b(8), which points out the point of time, 139(1) due date is the point of time. Unlike that, these sections 80 IB etc. only says along with the return of income, there is no point of time which is defined. So that would have been, according to me, the right way of distinguishing. However, the Supreme Court has distinguished in a different manner, which really creates some sort of difficulty. And the Supreme Court says that when this was pointed out, it says no, this particular case law was on 32(1)(2) and 80 IB. 10b is an exemption provision. 80 IB is a deduction provision. You can't compare the two, and therefore I'll not look at that. And 32(1)(2)A also cannot be compared with an exemption provision, and therefore I'll not look at that decision. So this is the way in which the Supreme Court has distinguished this decision, and this is what something which creates a problem or raises doubts going forward. Why? Because there are many provisions for filing audit report along with the return of income, not only in chapter 3, not only in chapter 6A, but also in chapter 3. Will the interpretation be different in different sections? So if I have to claim an exemption under 1023A and I have to file an audit report along with the return of income, then this provision will apply. This particular case law will apply. But if I want to claim 80 IB in chapter 6A, then this case law will not apply, but the earlier case law will apply. That sort of a situation comes out, from this decision. Of course, in section 11 and 1023C may not be a right example because there the law itself has been amended, and they have made it very specific that you file all these before the due date of filing the return. But there could be several instances, and I think an exercise has been done. The language is prescribed under various provisions for filing report certificate forms are broadly under 4 different categories. One are the type of section which says before the specified date referred to in 44AB, which in turn refers to 139(1). So, so the first and the second bullet actually refers to 139(1) due date. Then on or before or just before. That is second type of cases. And third type of cases are along with the return of income. And you tried to find out or make a list of various sections which uses different nomenclatures. Like this set of sections says before the specified date under 44AB and 139(1, on or before the due date under 139(1. These are the provisions which lay down this particular. So there are a long list of sections. It runs into, I think, 10 slides. It uses different languages along with the return of income. So the point here is that would the interpretation be different because one section says along with the return of income and the other section says 139(1? I would feel that should be the way of distinguishing the two decisions. But the way it has been distinguished by the Supreme Court, you may have situations where under chapter 3, if 139(1 due date is written, you are gone. But if under chapter 6A 139(1 return is mentioned, you may be better off. Now that's you can't be better off, because 139(1) is a specific date. Even if it is falling under chapter 6A, you will have to file before that date. Otherwise, you might say that for the purpose of section 80, even if I file late return, it will be directory and not mandatory. You can't apply GM knitting for section 80, even though it says 139. And just because it is not there in exemption provision, you cannot give a liberal meaning to section 80 over there. So, so that could be a consequence, but I guess it's not something which is unsurmountable. Supreme Court has distinguished it. Maybe on two grounds. You may have different grounds of distinguishing it as well. And therefore, my personal view is that wherever the law requires you to file something along with the return of income, I think GM meeting case law would still continue to apply to you, irrespective of whether you fall under chapter 3 or you fall under chapter 6A or you fall under any other provision of the Act. And then I think you may just make a note of this decision. It's an interesting decision on issuance of notice. I think these slides will be circulated to everyone by the chamber. And you may take note of this decision, which really talks about principles of issuance of notice when it is to be digitally signed. It will be dead to have issued at that point of time. It is not issued before it has been digitally signed. And when it is served on you, it is served on you when it is on your e-portal. If it is not on your e-portal, when you have actually seen that, and so on and so forth. Interesting principles insofar as 282 is concerned, and your digital service of notice, etc., is concerned. It's a good decision to be which really lays down these principles. Delhi High Court.
Section 50 CA is applicable only if consideration is less than fair market value. But in case of conversion of company into LLP, we are not aware of consideration. How the valuation mechanism will work in such case?
Yeah, you are not aware of the consideration. I answered that. Your consideration is not determinable because of Sunil Siddharth Bhai, but because of 50D, which sort of overrides Sunil Siddharth Bhai. Your consideration has to be the fair market value of the shares which have extinguished. And, right. and therefore, that is the consideration of 50D. And how do you determine that fair value? Go to 50CA.
50CA.
50CA, yeah, CA. Yeah.
Okay. Second question is, sir, in case of non-compliant conversion of company to LLP, whether tax will be applicable on factory land and building, which is transferred on book value, whether 50C will apply?
No, because 50C applies only when the transfer is of a property being land or building. Now here, what is transferred is the undertaking as a whole. Now, if an undertaking as a whole is transferred, the individual item of assets and liabilities cannot be considered over there because of the principle laid down in R.C. Cooper and several decisions. You had Punjab National Bank as one of the latest decisions before the slum sale amendment came in, and it actually discussed the slum sale amendments also and said that so on individual item of assets the consideration cannot be attributed or taxed. So that I think answers the question.
Yes.
So there is one question. Yeah. Okay, go ahead.
Please go ahead.
There is one question in case of Wipro ruling, which says that how do we consider Supreme Court ruling in Dilip Kumar and Ramnath and Co. in light of Wipro ruling? Yeah. How do we suggest that such requirement to file a particular form before due date is substantive condition and not merely procedural?
Yeah. So yeah, it's a very valid question. Dilip Kumar, I should have covered in the slide that there what it says is that when you have to enter an exemption provision, you have to look at the entry strictly. But having entered a provision, whether certain conditions are fulfilled or not fulfilled, you take a liberal view on that subject. That is the bottom line of Dilip Kumar's decision. And considering that, at the entry level, if I am eligible, I will be entitled to. But at the entry level, there is a condition which is placed that it has to be filed before a due date of filing the return of income. Then taking a liberal view of the matter may be a difficult situation, because the law provides 139(1) specifically. There is a specifically date which is pointed out, and therefore you have to comply with that date. Now, along with the return of income stands on a different footing, although there is a condition, but that condition will have to be fulfilled anyway, because if you don't file an audit report, you will not get section 11, you will not get section 80IB, etc. But along with the return of income takes a different flavor as compared to the mentioning of the due date. So therefore, while I agree that Dilip Kumar's case ought to have been followed, I mean, I guess one could have argued that in Dilip Kumar they have said that, look, this is forget mandatory or directory, but Supreme Court has said in Dilip Kumar that you look at the eligibility. Once I'm eligible, all other conditions you have to take a liberal view of the matter. Okay, so one could have argued that, but well, I think that is something which in retrospect one may think about it. And considering that this is now a decision of Supreme Court, all that you can probably do is to distinguish between the language of the two sections, where the section mentions a due date and when the section does not mention a due date and just says along with it. You had SICA earlier, which had specific provisions which said that SICA would override other laws. You had specific provision that your scheme of amalgamation in when something is covered under SICA BIFR, then 72A provision of section 72A shall, subject to the modification of power of government under that section, may be exercised by the board without any recommendation. So it gave power to the board, to the BIFR, to exempt exempt a company from certain provisions of the Income Tax Act, which would override. Now, and then you had specific provision in 47(12), transfer of land by the company under a scheme sanctioned by SICA would also be exempt from capital gains tax. There were certain provisions specifically. Unlike that, in insolvency and bankruptcy code, you do not have those omnibus provisions, but you have this provision in 31(1). It says if the adjudicating authority is satisfied with the resolution plan, okay, as approved by the committee of creditors, meets the requirement as referred to in 32, it shall by order approve the resolution plan, which shall be binding on the corporate debtor and its employees, members, creditors, including the central government, state government, or local authority to whom a debt in respect of any payment of dues arising under any law for the timing in force, such as authorities to whom statutory dues are owed, guarantors, and other stakeholders. So therefore, the resolution plan which is approved, okay, based on your resolution, the approval of the order of the NCLT read with the resolution plan which is approved will be binding on the government authorities, and this is the provision which really says that, look, if you are provided for some relief under the Income Tax Act and that has been approved by the NCLT, then that particular benefit will be available to you. Now, you also have this provision that the code will override other acts, etc. Then in the Income Tax Act, you have, in two cases, you have specific provision in 79 and 115 JB. Now, 79 is the interesting provision which makes this very interesting, that 79 relief is almost automatic because Income Tax Act governs it. It says that what? It says that nothing contained in subsection 1, that is 79(1), which says, that more than 51% shareholders changing hands, the loss will lapse. So nothing contained in subsection 1 shall apply to a company where a change in the shareholding takes place in a previous year pursuant to a resolution plan. What's happening? Pursuant to a resolution plan approved under the IBC. Okay. If we read just up to here, then 79 is almost automatic. That if there's a change in shareholding, you might not have asked for that relief under the plan. But if there's a change in the shareholding pursuant to the plan, then 79 will not apply. However, it doesn't just end there, but it says that after affording a reasonable opportunity of being heard to the jurisdictional principal commissioner or commissioner. Now, here is where the problem lies, that many a times we don't find any records as to whether this resolution plan has been heard after affording a reasonable opportunity of hearing to the tax department. Committee of creditors may have the tax department as one of it, one of the creditors, but having looked at the plan, has the commissioner been invited to give me section 79 relief specifically? Is there a opportunity of hearing to the commissioner in respect of this scheme? Is a question that one needs to answer. So therefore, as a matter of practice, one has to write in the scheme even the 79 relief, although there is a specific provision in the statute, claim that specifically, and if the tax department has been given an opportunity, there is no difficulty, but you don't have any records except to say that tax department was part of a committee of creditors, and the committee of creditors has been taken into account or heard. Then probably you stand some success insofar as 79. So one do's over here is that even though it is almost automatic, you please write in the plan which gets approved that this is the relief that I'm specifically asking for. Then 115 JB says that if any amount referred to in so what it says is that the losses normally for all MAT cases, the loss or depreciation whichever is lower is allowed to you. However, in case of a company against whom an application for corporate insolvency resolution process has been admitted by the adjudicating authority, such companies would be allowed loss or depreciation whichever is high, not whichever is higher, but both. Now, but then this is only up to the stage where the IBC, where the order has been passed. It's not, it's up to the stage, before the stage rather, that the order has been passed. It is not after the stage of order has been. But in terms of relief, 79 becomes little important. However, at the same time, there are no specific provisions in the Act like 79. There are no specific provisions so far as 41(1) is concerned. So a huge write back of several, haircut that the creditors would take. What happens to that write back? So I need to ask a specific relief over there, which has to be, which is to be part of my resolution plan, which has to be approved. Then even those write backs should not be taxed under MAT if you have not opted for the new regime and you are in the MAT. You need to ask for that. You need to ask for section 45 relief in case of transfer of any assets or transfer of shares, etc. You need to ask for section 56(2)(10) and 56(2)(7)(b) relief because you're going to issue shares to the new shareholders, or you're going to receive any property under the IBC. There can be several situations. So these sort of reliefs, where there are no specific provision in the Income Tax Act, you should definitely ask for those relief and get a para on that in the order. And even if, as I said, even in 79, you should ask for it because giving a hearing to the tax department is critical, and in order to claim that relief under 79. So this is some do's and don'ts which I thought I could summarize.